From April 2027, most unused pensions will be pulled into your estate for inheritance tax. In some cases, HMRC will take more from your estate than any of your actual own children will receive. However, there are steps you can take right now before 2027 that could reduce that bill by £250,000 or more. In this video, I'm going to walk you through 3 of them. And the first strategy is to use your pension strategically. The first thing you need to understand is that from 2027, leaving your pension untouched until you die is no longer the automatic best move like it was before. For years, the advice was to spend everything else you had first. Leave the pension alone and pass it on to those that you love and care about. And from 2027, all of that changes. One of the most common things we see is people treating their pensions like it's off limits or out of bounds. They live off everything else and they leave the pension sitting there because that was the smartest thing to do previously. However, from 2027, that pension is going to be counted in your estate. And if it's large enough, 40% of it could go to HMRC rather than the people that you care the most about. So if you're now thinking, I have no idea what Chris is talking about, we've made a separate video about the changes that are coming and are applicable to inheritance tax and what this means for you. If you'd like to watch that video, you can click the box on the screen now or just click the link below in the description box. So now we need to ask, how do I move my pension out of my estate while I'm still alive? And here's how this works in practice. If you draw money from your pension during your life and gift it, and you survive 7 years, that money falls outside your estate. However, it's important to note you do pay income tax when you draw it. But if the alternative is your family paying 40% inheritance tax on it when you die and also paying income tax on it, drawing it and gifting it now can actually be the best outcome. That way you get to see your family benefit from the money while you're still alive. As we always say, it's best to give with a warm hand than a cold one. Let's put some numbers on it next. So say you draw £500,000 from your pension and gift it over a period of time. If you survive 7 years, that £500,000 is outside of your estate. At 40%, that saves £200,000 of inheritance tax. But planning here is super key. What you don't want to happen is to gift what you can't afford and be left in a position where you don't have enough for your own retirement. So for example, I wouldn't advise withdrawing £500,000 from your pension to gift when your pension has a total of £550,000. That'd just be silly, as it would leave you in a difficult position and ultimately could lead to you relying on your kids for support. It's all well and good to reduce your own inheritance tax bill, but not at the expense of your own financial security and standard of living. Planning these things can take time, so it's important you start thinking about this before the 2027 deadline. We have just seen how we reduced the bill by £200,000. How can we reduce it even further? Well, the second strategy we can use is gifting from surplus income. Most people know you can gift money during your lifetime, but what people don't know, there is a specific exemption for regular gifts made from income, and it's one of the most powerful tools available. This gift doesn't have a 7-year clock attached to it. It immediately falls outside of your estate. When I explain it to clients that they can gift money to their children every year from their income, and it's immediately outside of their estate, the reaction is almost the same every time. They can't believe it's that straightforward. It is not something that is widely talked about, which means a lot of families are sitting on a huge opportunity they're just simply not using. And this exemption is called normal expenditure out of income. And the rules are fairly straightforward. The gift must come from income and not capital. They must form a regular pattern, and after gifting, you must still be able to maintain your normal standard of living. So let's look at what that means in practice. If you've got 25 grand per year of surplus income and you gift that amount each year for 10 years, that's £250,000 moved outside your estate. And at 40%, that reduces the inheritance tax bill by £100,000 with no 7-year wait. Used consistently over time, this exemption can do a significant amount of the heavy lifting for you, but it does need to be documented properly to hold up. So again, it's very important to structure this properly and make sure you're getting financial advice to ensure that it does not become a problem for you or your children later on down the line. Now we've covered 2 strategies that you can use while you're alive. The third one is about lifestyle decisions, which can also become part of the plan. So strategy number 3 is downsizing. Property is often the largest single asset in an estate. And for many people, there comes a point later in life where their family home is simply too big for their new lifestyle. When that happens, downsizing is a good option, but not just as a lifestyle decision, it can also be a significant inheritance tax planning opportunity too. And I've spoken to a lot of people who feel like they have to stay in their home because they feel like moving would somehow be giving something up. But when you actually look at the numbers, moving to a smaller property and releasing some of that capital and then gifting it can save your family a significant amount of money and probably a lot of headache for you personally too. It also means a simpler, more manageable home at a stage in life when you don't need the hassle that comes with owning a big house. So let's look at how it works. If you sell your home and move to a smaller property that costs less, you may release capital in the process. That release capital does not immediately fall outside your estate. But if you choose to gift it and you survive 7 years, it will be outside the estate. So for example, if downsizing releases £300,000, which wouldn't be unusual on a bigger house, and you gift that amount, after 7 years, it's outside of your estate. At 40%, that could save £120,000 in inheritance tax. This only works if it aligns with how you actually want to live. It is not something to do purely for tax reasons. Again, this is something that requires planning and should be discussed with your advisor or planner. Okay, so let's go back over everything and recap. In our example, the starting inheritance tax bill was £600,000. And after we looked at strategy 1, we had the pension drawdown and gifting, which saved £200,000. Strategy number 2, we had the surplus income gifting, where there was £100,000 saved. And strategy number 3, the downsizing and gifting, where there was £120,000 saved. Altogether, that's a total potential saving of £420,000. Even if only part of that is achievable in your situation, reducing the bill by £250,000 is very realistic with the right plan in place. But this is not really about tax. It's about what you have built over your lifetime and who gets to benefit from it. Whether it's helping your children buy a home, giving your grandchildren a better start or education, or just knowing that the people you love are going to be looked after. That is what planning is actually for. The tax bill is just the thing standing between you and that. April 2027 is not far away, and some of this planning takes time to put in place properly. If you would like to understand how these strategies apply to your situation, the link in the description will take you to a no obligation free call with a regulated financial advisor. And if you have not yet watched our breakdown of what is actually changing in April 2027, that video is linked on screen now. This is the starting point. Thanks very much for watching and have a great day ahead.